Understanding credit scores and how to improve them. Hello, everyone. My name is Dave Tallman. I'm a certified mortgage consultant, also the owner here at Mortgage Solutions of Georgia. I'm also a certified FHA DE underwriter. I've been in the business over 20 years now. And so today we're going to discuss credit scores, what they mean to you, and how to improve upon your score situation. Little disclaimer. For myself personally, I've never subscribed to the thought that an applicant needs to pay a credit repair company in order to improve an applicant's credit score. I have very, very rarely seen that to be successful. And what I do believe is that an educated consumer is the best kind of consumer. I oftentimes find that knowing uh, what to do and why you are doing it often leads to great success. So, with that being the case, let's just get right into it. Um, okay, here's what you need to know about credit scoring. From a high level, everyone who utilizes credit is generally going to have three different credit scores, one score from each credit bureau. The three credit bureaus are Equifax, Experian, and TransUnion. Okay, so think about it in this way. These credit bureaus are for profit organizations. Each of them have their own formula for how they derive an applicant's credit score, all of which are slightly varying and a little bit different, which is why oftentimes when we review an applicant's credit score, they're going to have three unique credit scores that will change month in and month out based on the previous month's account activity. Okay, so that's important to note. The other thing that you need to know is that there are many, many, many different variations of credit reports. So, for example, if you go to a car dealership and you buy a vehicle and they run your credit at the dealership, that score may be and likely will be different than the credit score that a mortgage lender pulls. And the reason for that is because um, at an auto dealership, they're going to weigh how you repay and how you handle your installment loans more heavily. And on a mortgage credit report, we're going to look at different accounts and how you manage those accounts a little bit differently. So there is a difference in your credit score depending on what the intent of the credit application is used for. Okay, let's get right into credit scoring. When you think of a credit score and how your unique score is derived, I want you to think about a pie chart. And within that pie chart, each piece of pie is maybe one piece is a little bit bigger than the other piece. Okay, so the five factors that you need to consider that make up your credit pie is the first one is the most important. In this weighs about 35% of your credit score is derived from your payment history. So, do you pay your bills on time? That's a pretty important piece. And we're going to go into a little bit greater depth on each and every one of these later on in the presentation. Um, so I'm just going to hit you with the high notes here initially, and then we're going to do a little bit deeper dive into each one of these. Number two is your credit utilization rate. That will create about 30% of your credit score. So between the payment history at 35% and your credit utilization rate at 30%, these two factors alone make up about 65% of how your credit score is derived on a monthly basis. So these two of the five are by far the most important. What is your credit utilization rate? The credit utilization rate measures how much credit is available for you to use versus how much of that credit you're using. So, for example, if you have a credit card and your credit limit is $1,000, but you're using or you're borrowing 900 of the $1,000, then that means means that your credit utilization rate is 90%. And that's not what we want to see, but we'll discuss that further on in the presentation here. Number three is length of credit history. The longer history you have, the better it is. So we're looking specifically at the age of your trade lines, how long that you've had this credit card for. That makes up about 15% of your credit pie. Number four is the types of credit you have. This makes up only about 10% of your credit pie. However, it's important to note that the credit bureaus would prefer that you have a mix of different credit types. So, for example, maybe somebody's got a car loan and a credit card. So, a car loan would be like an installment loan versus a credit card would be a revolving trade line. So, 10% of your credit pie is made up of types of the different types of credit that you have, and they would prefer that an applicant have a mixture of different credit types. And then lastly, is recent credit inquiries. So, multiple inquiries can lower your credit score, but this only attributes to about 10% of your score. So, from top to bottom, number one, payment history. Do you pay your bills on time? That's at about 35% of the credit pie. Number two is your credit utilization rate. That constitutes about 30% of your credit pie. Number three would be length of your credit history, which is only at 15%. Number four is types of credit, which is at 10%. And then number five is your recent credit inquiries, which again is only at 10%. Okay, it is important to check your credit report and know what's on there. You can access a free credit report of yours online. You can also access a free credit report once a year from any of the three major credit bureaus: Equifax, Experian, and TransUnion. It's important for you to know that errors on your credit report can result in higher interest rates or loan denials, even. And you need to know that if you see something that's incorrect on your credit report, there is a dispute process in place. Okay. So if you see something that's not right, you know that it's not right, then you can dispute that derogatory event, and then the credit bureaus will get with the creditor, and they will investigate to determine if this is something that rightfully should be on your credit report, or if it was reported an accident or error. If that's the case, then they can remove it, and then you can likely experience a little bit of a higher credit score due to getting that piece of derogatory credit removed from your credit report. Just a word of caution on this disputing process. So, if you were to hire a credit repair company, um, one of their common tactics to try to get derogatory credit removed from your credit report is that they will just go in and dispute everything on your credit report, whether it should be on there or not. Uh, the word of caution on this, however, though, is that if you're applying for a home loan, the underwriter doesn't want to see that you've got a bunch of disputed collections on your disputed accounts on your credit report. And the reason for that is because when you dispute a trade line on your credit report, while that dispute is being investigated, it is not factored, that particular trade line is then not factored in to your overall credit score. So oftentimes what we see is that a credit repair company will go in and dispute a bunch of accounts. And so initially, maybe they win some of those, and some derogatory credit is removed from your credit report. But generally speaking, that's a short lived score improvement, and sooner or later those bad debts that are rightfully so on your credit report end up coming back onto your credit report and hurting you all over again. So you never want to dispute something that's actually valid, but if there is something that is legitimately incorrect and you can prove it, then that would be something that you would certainly want to dispute. Okay, but by no means do you want to go in and just start randomly disputing every piece of derogatory credit, because that can negatively impact your mortgage financing. Okay, all right. Let's take a little bit deeper dive on the five main things that factor into your credit score. And let's take number one, which was paying your bills on time. So, uh, guys, this sounds pretty simple. If you pay your bills on time, you're likely going to have a higher credit score. If you don't pay your bills on time, then that's going to negatively impact your score. So, big picture, if you're applying for a mortgage loan and you're asking the lender to lend you a couple $100,000 to buy your house, but you can't pay a $35 minimum credit card payment, then this is going to poorly reflect on you. Okay, so having an on-time payment history on all of your bills, the report to credit is critically important, and it's so important that it constitutes 35% of your overall credit score. So on-time payment history is absolutely critical if you want to try to improve your score and then ultimately buying a house. Okay. Consistently paying bills on time shows reliability and minimizes negative marks on your credit. And a strong credit score can lead to better loan terms, lower financing rates, lower mortgage payments. So, number one is you got to pay your bills on time. It's critically important. Number two, we want you to reduce your credit card balances. This plays into your credit utilization rates. The important number that you need to know is 30%. Okay, so just as a recap, your credit utilization rate looks at how much credit is available for you to use, and of that available credit, how much are you using? So the example earlier I gave was I've got a credit card with $1,000 credit limit, of which I'm borrowing $900. That means that your credit utilization rate is 90%. So the magic number that you actually want to get to is 30%. Okay. So if you got a high credit limit of $1,000, you don't ever want your credit card balance to be above $300, which is 30% of $1,000. Now, here's the tricky part of your credit utilization rate, okay? And a lot of people either don't know this or won't tell you this, okay? But I'm going to break it down for you and talk to you like a real person would, okay? Um, every creditor, so Capital One, Visa, MasterCard, department store creditor, they're going to report back to the credit bureaus one time per month and they're going to give the credit bureaus, hey, I've got Mr. Jones here. He's got a credit card with us with a high credit limit of 1,000. His balance is this, and he paid us on time. Okay. The credit bureaus are going to take that data, analyze it, and then formulate it back in the form of a credit score for that applicant on that given month. Okay. Now, here's the challenge. Okay. We don't know, you don't know, I don't know, nobody really knows when the creditor is going to report that data back to the credit bureaus. Okay. Um, Capital One may do it on the 15th of every month. First Premier may do it on the 21st of every month. Okay. Discover may do it on the 6th or 7th of every month. Okay. Point being is that we don't know when the creditor is going to report your account information back to the credit bureaus. And because we don't know when that data is transmitted, this is where it becomes critically important that your credit card balances must be below that 30% threshold during the entire billing cycle of the credit card. Okay. And here's why that's important. Okay. I see this in a real life, day in, day out, when I'm talking to my applicants and I'm taking mortgage applications. I come across a lot of applicants who they pay all their bills on time, um, and so that's good. But they're running a high percentage of use or a high credit utilization rate, and so that's not good. Okay, so what occurs is I pay the bill on time, so my score goes up, but because my percentage of use is high, higher than 30%, my score comes back down. So what we've created here is kind of a canceling out effect. Okay. So a lot of applicants say, I might ask them, hey, how do you think your credit looks? Oh, Dave, I always pay everything on time. I pay things in advance. I should have great credit. And then when we look at the credit, it's maybe average or not so great. And the reoccurring theme there is that, well, yes, this client is paying their bills on time, but they're also running a high percentage of use or a high credit utilization rate. And so they're not getting the consistent score improvement that maybe they'd hoped to do. So in order to maximize, and this is, guys, I just want you to kind of really focus in on this because of this whole presentation. This is probably the most critical aspect for you to grasp and understand. In order for you to get score improvement month in and month out, and that's the objective, we want your score to get progressively better every single month. And we want to maximize what that score improvement is every single month. But in order for you to do so, you must do number one and number two at the same time. You must pay the bill on time because we know that that's about 35% of your score, but at the same time, you must also maintain a low percentage of use during the entire billing cycle of that particular credit card, because we don't know when the creditor is going to report back to the credit bureaus what your activity has been over that previous billing cycle. Okay. So we got to do two things if we're going to maximize score improvement. We got to pay the bills on time, and we got to maintain a low credit utilization rate, and your target number is 30% or less. So, helpful tip for you, okay, so that you can apply this in real life. All right. What I oftentimes advise my clients to do is to make a list of all their credit cards that they have balances on, and then list the creditor name, list the credit limit, and then list your particular balance at that particular time. Just handwrite it out and stick it on your refrigerator. That way, you got to look at it every single day. And then you're on that same list. I also want to see you um, marking out 30%. So I've got this credit card, it's, $1,000, so I need to be at $300. Or I've got this credit card and my credit limit is only $500, so I need to be at $90 or below at this particular card. Okay. And just start making payments and gradually lowering your credit utilization rate on each and every one of these credit cards. And you're going to see your credit scores kind of take off very, very quickly. Okay. All right. Number three, we want to avoid opening too many accounts too quickly. Okay. Um, Multiple hard inquiries from new credit applications can lower your overall credit score. Opening numerous accounts can reduce the average age of your credit history because length that your credit has been opened is one of those determining factors to your credit score. Okay, so we have to be careful there about opening too much credit too quickly. Okay. Um, and lenders might also perceive that you opening multiple new trade lines onto your credit may indicate that you are in some sort of financial distress or debt accumulation. So just be very careful about the kind of credit that you open, but also opening too much of it in a short duration of time. Okay. Um, if your loan officer or my team suggests that you open new credit, then definitely heed their advice, but make sure that you're opening the right kind of credit that's going to lead to higher and better credit scores. Okay, number four, we want you to diversify your different credit types. So I kind of touched on this a little bit earlier, but um, the credit bureaus want to see that you have different varying kinds of credit. So like an installment loan would be like an auto loan, okay? Or a personal loan would be classified as an installment loan. The basic concept here is an installment loan would be like Hey, Mr. Jones, I'm going to lend you, $1,000, and you need to pay me back $100 a month until the loan is paid off. Okay. Once the loan is paid off, the account gets closed, and we're all good. Okay. That's different than a revolving debt. A revolving debt would be like a revolving credit card. So Capital One, First Premier, department store. The concept behind a revolving debt is that instead of giving you a loan for $1,000, I'm going to give you a line of credit for $1,000. The difference is that once you pay off the installment loan, that account is closed and done. But with a revolving loan, you can charge up to $1,000, pay it down, charge it up again. But of course, we don't want to charge all the way to 1,000 because we just covered that. We only want to charge up to 30%. Okay, but a revolving credit card doesn't ever close unless you close it yourself, which you never ever want to close an open revolving credit card. Um, but it stays open and it's available for you to charge up, pay down, charge up, and pay down again. Um, Ideally, perfect credit score. I mean, I've seen, you got to understand that less than 1% of the American population has scores in the 800s. We do see those pretty good bit in our office. And the one reoccurring theme that I can tell you that gets you to the 800 mark is you have a diverse credit portfolio. So this applicant traditionally would present themselves. They've got a mortgage, they might have a car loan, and then maybe one, two, or three credit cards. So they've got all three different kinds of credit reporting on their credit. But not just that, they've typically had these kinds of trade lines open for many, many, many years. Okay. um, all right, so that touches on that. Okay, a couple of tips here to help protect your credit score. So, number one, you want to limit and strategically time out credit applications. Okay, you don't want to just be applying for, three, four, five, six credit cards all at one time because it's Christmas time or it's Labor Day and somebody's offering, wonderful financing. Maybe they give you a $50 gift card if you open a credit card. Like we don't want to do that. That's not worth doing the credit inquiry for. So we want to be strategic in what we are actually the kinds of credit that we're applying for. Okay. You also, in the case of a mortgage, okay, you want to really research different lenders. You want to interview your mortgage lender, have good conversations with them before you just jump in and start having them run your credit. Okay, not all mortgage lenders or loan officers are created equal, so you want to have a good conversation with them. You want to ask them some tough questions. Hey, how are you going to help me in this transaction? What are your rules? What are your responsibilities? You want to feel real comfortable with your loan officer before applying with them and allowing them to pull your credit. So definitely encourage you to talk to a couple different people, and then coming from those conversations, you're going to get a real good feel for kind of who you feel like is going to be the right person for you to work with and the right person to get you to the closing table and get you into a home. Obviously, we want to regularly monitor credit. We want to be checking for errors or unauthorized credit inquiries. Um, we want to keep older credit accounts open so that we can maintain a longer credit history. I see this mistake very, very common in our office where I pull someone's credit report and they just recently closed a whole bunch of open trade lines, revolving credit cards, a lot of times. And they'll say, well, Dave, I didn't use this old card. I've had it for 10, 12 years and I just closed it to close it. I mean, I never use it. Right. And that can significantly harm an applicant's credit score because we're erasing maybe a decade worth of credit history for that applicant. And although it may only attribute 10% of your overall credit score, it also impacts uh, a lot of people don't think about this, but it also impacts your credit utilization rate, which constitutes about 30% of your overall credit score. So between the 30% credit utilization rate and the 10% length of time that you've had the credit, that's up to a 40% right there. So we never, ever, ever want to close an open revolving credit trade line. That will hurt your overall credit score 100% of the time. So please, please, please do not make that critical error. And then obviously, we want to reduce your existing debt to improve upon your credit utilization rate. So one thing, when I review an applicant's credit report, and maybe they've got a little bit lower scores, and I'd like to get some score improvement out of that applicant pretty quickly, the first thing that I look for is their revolving credit cards. And I would go back and say, hey, Mr. Applicant, right now you're sitting at a 620, but if we can get you over the 640 or 660 mark, maybe it takes you paying a couple $100 towards this credit card to uh, to reduce your credit utilization rate. Oftentimes that's worth it because that could potentially lead to a lower financing rate. So these are conversations that you can be having with your loan officer to try to get you worked into a little bit of a better position. Um, Another tip that I've seen successfully work is having you added to somebody else's credit card. So, for example, um, maybe you're an applicant that's got lower scores because maybe you just haven't had credit for a long time. Maybe you recently, you're in your early 20s. You haven't had an opportunity to really go out and learn about credit or open revolving credit cards. So one trick that you can do is maybe if you've got a grandparent or a mom or a dad, and they've got decades of good on-time paying credit history. They can actually call their credit card company and add you as an authorized user on their account. So, as an authorized user, you technically have ability to use that credit card, but you wouldn't have that ability if mom or dad doesn't ever give you the actual credit card to use. But more importantly, you will be added to their credit card, and then this trade line will then be reported onto your personal credit report. So if mom and dad had a credit card for the last decade, they've always paid this card on time. They maintain a very, very low balance on this particular credit card that you're being added to. Then as long as you're added as an authorized user, this trade line will now start reporting onto your credit report, and you can sometimes reap the benefits of their positive credit history. Okay. Now, important to note, conversely, this can hurt you as well, right? So you don't want to be added as an authorized user to an account that's got a high percentage of use or a high credit utilization rate or has a very bad payment history, because then that won't help you. That'll actually hurt you. So we have to be careful with that strategy, but I have seen that strategy successfully work in the past. Okay. All right. We've already touched on this, but we obviously want to keep older credit accounts open because this can positively impact your credit score. The length of your credit history, including the average age of your accounts, is one of the keys to a higher and better credit score. And then older accounts, if you do have older trade lines that have been open for 5, 6, 10 years, older accounts suggest reliability, and closing them can harm your credit profile. Okay. Before we conclude here, a couple of other helpful tips that I want to draw to your attention. Um, Many of the credit bureaus, Equifax, TransUnion, and Experian, if you pop onto their websites, I know for sure that Experian has a program called Experian Boost. This is free for you to sign up for, and it will allow you to report other things to your credit report that traditionally don't report to your credit report. Things like your rental payment history, things like paying your light bill or your cell phone bill. Okay. So this is a quick, easy way to try to get some score improvement. And it's a free service that Experian offers. It's called Experian Boost. I'm certain that Equifax and TransUnion also have similar type programs. I'm not aware of what those are, but I would recommend that you visit their websites and do a little searching around to see what they have available. And then the other big one I want to just touch on is Credit Karma. So I get a lot of applicants that call in. I ask them how their credit is, and they say, "Well, Dave, Credit Karma says my credit is a 780 score." And then when we look at it, it's a 620 score. Well, why is that the case? Well, we touched on this a little bit earlier, but understand that. Uh, the way the algorithm, the mathematical equation of how these credit bureaus derive your credit score month in and month out, I liken it to the Coke recipe. Okay, Coke list out what their recipe or what their ingredients on every single Coke can, but they don't give you that little 1% ingredient. Okay, credit bureaus are the same way. Okay, so they're never going to release uh, what their formula is to other companies like Credit Karma, because they don't want that information to get out. If that information got out, or a Credit Karma figured out what that formula is, then the credit bureaus would be out of business. Okay. So they're never going to figure out what that is. But what Credit Karma and other free services try to do is figure out what that formula is. Okay. And so sometimes your Credit Karma score is close to what your actual score is, but I would say more times than not, it's pretty far off. Okay. So, what I advise my clients to do is, I'm not opposed to you having a Credit Karma account. I wouldn't pay for it, but if they have a free one, I'm not opposed to that. What I tell my clients is, if you're doing the right thing credit wise, you're going to see your Credit Karma score go up. Conversely, if you're not doing the right thing credit wise, you're going to see your Credit Karma score go down. Other than that, that's the only reason you should be using a Credit Karma account, because the scores themselves are very, very rarely accurate. Okay. So I hope that this credit scoring webinar has been helpful and useful to you. But if you do have additional questions, or if you would like us to speak to you and speak to you specifically about your credit situation, we always welcome that. Just call our office at 770-924-1111 at any time. My team will set a consultation where you and I can jump on the phone. I'll be happy to answer any questions that you all have. And I appreciate you taking time to sit through this. And I hope the information was beneficial for you. So take care.